Okay, let's dive right into this. Today, we're breaking down a highly specific, strictly quantitative standard within the mortgage finance industry. We're going to completely demystify the SASB metric FNMF-270B.1. Look, if you're an analyst or you're preparing sustainability disclosures, you already know that calculating discriminatory lending risk, well, it requires absolute precision. So this explainer is your quantitative guide to doing exactly that. We're getting straight to the math and those strict reporting parameters.
Here's our roadmap. First up, standardizing fair lending data. Second, defining our borrower categories. Third, scoping out the mortgage portfolio. Fourth, calculating that weighted average LTV. And finally, reporting the final metric. We're going to step logically from the big picture regulatory concepts right down to the nitty-gritty math.
So, Section 1, Standardizing Fair Lending Data. Let's establish exactly why this highly specific data matters so much to both investors and regulators. The mortgage finance industry obviously aggregates a massive amount of data to figure out loan terms, right? Loan size, interest rates, fees, the whole shebang. But this incredibly complex process can sometimes lead to intentional, or more often entirely unintentional, discriminatory lending practices. And the core problem here is massive. Discriminatory lending risks severe regulatory fines, massive reputational damage, and ultimately it leads to negative financial performance because of loan mispricing. So proactive monitoring and reporting, it's absolutely crucial for protecting shareholder value by exposing those hidden risks before they blow up. So the crucial point is getting totally aligned on the exact SASB metric we're tackling today, FN-MF-270B.1. You'll notice there are three very specific quantitative outputs required here. You have to report the number, the value, and the weighted average loan-to-value ratio of the mortgages. Plus, you've got to split this data into two distinct demographic buckets: mortgages issued to minority borrowers and mortgages issued to all other borrowers.
Moving right along to Section 2, defining the borrower categories.
Before we run a single calculation, we have to nail down these foundational definitions. How exactly do we define a minority borrower for this metric? Well, the standard specifically points to the United Nations Office of the High Commissioner for Human Rights. They define a minority as any group constituting less than half the population in a state whose members share a common culture, religion, or language. And what's really important to emphasize here is that a person belongs to this group without any need for proof of citizenship, residence, official recognition, nothing like that. It is a very broad, universally applicable definition.
Now, when you're dealing with individual applications, the baseline rule is super straightforward. If a single applicant is of one or more race or ethnicity, based on that UN definition we just talked about, you simply categorize that mortgage as minority. It's just a clean, binary classification for solo applicants. But what happens when multiple people apply for a loan together? This is where things get a little tricky. So the standard dictates a very strict, step-by-step logic to ensure reporting stays perfectly standardized across the whole industry. First, obviously, identify if the app has more than one applicant. Second, and this is key, look exclusively at the primary or first co-applicant. Third, if that primary applicant is categorized as minority, boom, the entire mortgage is categorized as minority. You absolutely do not average out the demographics of the applicants. The primary applicant alone determines the category for the whole loan.
We also need to briefly touch on multinational entities. Operating across borders, the rule here is highly specific. You must categorize applicants based strictly on the jurisdiction where they actually applied for the loan. So, the local demographic context at the exact time and place of the application is what dictates whether they fall into the minority or all other borrowers bucket for your final reporting.
Okay, Section 3, Scoping the Mortgage Portfolio.
Let's talk about the exact parameters and loan types that you have to pull from your database to satisfy this metric. Here's exactly what falls into the scope. You need to include first lien, actually both first lien and junior lien single-family residential mortgages. This importantly includes home equity lines of credit, HELOCs, as well as standard home equity loans. And here is a literally crucial detail for any analyst pulling this data. These loans must be held in the entity's portfolio at the close of the reporting period. Oh, and yes, you must include both the mortgages your entity actually originated and the mortgages you simply purchased.
Section 4, Calculating Weighted Average LTV. We're transitioning fully into the quantitative phase now. Let's deconstruct the specific formulas for loan-to-value. Before we even think about weighting the averages, we need those base LTV numbers. The standard dictates that the base loan-to-value ratios must be calculated in accordance with your applicable jurisdictional, legal, or regulatory requirements.
So while SASB is dictating the final weighting formula, your base calculation is relying on local regulations. And it's incredibly important that the entity transparently discloses exactly which jurisdictional requirements they used for that base calculation.
And this brilliantly illustrates the exact mathematical sequence you need to run, which comes directly from Rule 1.6 of the standard. First step, you take each individual loan-to-value ratio and weight it by its respective loan amount. Next, step 2, you sum up all of those individual weighted loan-to-value ratios. And finally, step 3, you take that total sum and divide it by the overall loan amount for that specific category. That simple 3-step process gives you the precise weighted average LTV required by the standard.
Which brings us to our final section, Section 5, reporting the final metric.
This is where all that filtered data and calculated math gets neatly consolidated for the public report. But before we look at the final table, the standard actually notes a voluntary enhancement. Entities can choose to further disaggregate the disclosure of both borrower groups by creditworthiness. It's totally optional, but doing this can provide investors with an even clearer, highly granular picture of the portfolio's risk profile when it comes to fair lending.
Now, what's really interesting about this is the finish line. This is Table 5, straight from the SASB standard, showing their specific recommended presentation format. You can see exactly where the numbers we just spent time calculating are going to live. There's a column for minority borrowers, a column for all other borrowers, and then your specific rows for the number of loans, the value, and that carefully calculated weighted average loan-to-value percentage we just mapped out. It's all right there.
So this brings us to a really critical question to end our explainer on today. Do your current internal data systems strictly align with these multi-jurisdictional and joint applicant categorization rules? Think about it. The math itself is pretty straightforward, but that data filtering at the very beginning, that's where so many internal systems just stumble. I challenge you to audit your internal compliance software against these very specific UN definitions and joint applicant rules we covered today. You've got to ensure your fair lending reporting is entirely up to standard. Thanks so much for diving into this with me, and we'll catch you on the next explainer.